In this video, we are going to work on question 37. On January the 1st, 2017, Process Corporation acquired 100% of the outstanding voting stock of Goldright for $1,980,000 cash, so which is the consideration transferred. On the acquisition date, Goldright had the following balance sheet, so those are the book value of those accounts. At the acquisition date, the following allocation was prepared. So this is the allocation schedule we normally prepared as our step 1. But we can modify this schedule a little bit to make this a more complete one. For example, we can, based on this current schedule, and prepare the excess annual amortizations. Okay, although at acquisition date, Process had expected $44,000 in future benefit from Goldright's in-process R&D project. By end of 2017, it was apparent that the research project was a failure with no future economic benefit, which means that the Process had to write it off as an expense. At the same time, it's going to be deducted from the investment account. On December 31st, 2018, so that's 2 years later after the acquisition, Process and Goldright submit the following trial balance for consolidation. There were no intra-entity payables on that date. Okay, so this is the 2 years later, the financial data. So first in this video, let's just calculate what is the excess annual amortization based on the schedule already prepared. So first, what we can do is that we just change the number a little bit. I remove this 100,000 and put 230 over here. Okay, so because we know that R&D is no longer there, it will be write off. So only need to worry about equipment. Equipment have 8-year remaining life, which means that every year there is going to be a $7,000 excess annual amortization because we do not amortize goodwill. Okay, so the total annual excess amortization would be $7,000. Alright, so I'm going to use next video to show you how to solve one of the homework questions. Question A. Show how Process derived its December 31st, 2018 investment in Goldright account balance. Okay, so right now we know that the investment in Goldright account balance is this one. Okay, the question is how the parent company derived this balance. So let's come back to the question, which means that we need to figure out what is the investment in Goldright balance at the end of 2018. And then first what we can do is that we can show what's the formula to calculate the annual balance of the investment account. So the annual balance of the investment account equals to its beginning balance, or the balance at the beginning of 2017, and plus the income from Goldright in 2017, and minus the excess annual amortization in 2017, and then minus dividend from Goldright in 2017. So those are the information we need to know from 2017. And we need the same information from 2018 as well. We need to know what is income from the reported income from Goldright in 2018, and then minus the excess annual amortization in 2018, and then minus the dividend paid from Goldright in 2018 as well. And one more information is related to the research and development failure. We need to write that off from the investment account as well. So if we look at this formula, let's see what are the information we know. Okay, we know the beginning balance. So beginning balance is the amount that of the fair value they acquired on the acquisition date, and this amount should equals to $1,980,000. Okay, so this is the beginning balance of the investment account. And then, do we know anything about the income from Gauchright in 2017? We don't know here for this one. And we know the excess annual amortization. This information is calculated over here, 7,000. So this is known. And also in 2017 we don't know anything about this dividend paid, so we just leave them there. And let's go to 2018. In 2018, what is income from Gauchright? And the information is given. The net income from Gauchright is 210,000. 210,000. Excess annual amortization, that will be 7,000. It's the same every year. And dividend paid by Gauchright be 25,000. So this number is given. Minus 25. How much? 25,000. So we have two unknown values, and the next question is how we get this income from Gauchright and dividend from Gauchright in 2017. So in order to get the value of these two accounts, what we can do is we can rely on this return earnings equation. Is because remember how return earnings is calculated. So annual balance of return earnings equals to the beginning balance of return earnings plus income and minus dividend. So based on the this trial balance at the end of 2018, we know the return earnings of Gauchright at the beginning of 2018. So this is also the return earnings at the end of 2017, right? Okay. So the return earnings at the end of 2017 should equal to its beginning return earnings, and its beginning return earnings is given. It's over here. So that's the return earnings on acquisition date, 650,000. So 650,000. Okay, and as to this 800,000. Okay, so then back to this equation. We may not know what is the income from Gauchright and dividend from Gauchright separately. However, taken together, we know that the difference between income from Gauchright and dividend from Gauchright should equals to 800,000 minus 650,000, and which means that we can get the value of these two accounts together. And if that is solved, then which means that in this equation we have already have the values of all of the variables, and that's how we get the balance of the investment at the end of 2018.